Welcome to the daily update, where I'll go over the action in the market for Tuesday, May 28th, and then we'll see how things look for Wednesday, May 29th. I hope that everybody had a really nice Memorial Day weekend. Mine was fantastic. Some really good things happened, other than a little geopolitical visit that ended up throttling down internet speeds. I could download okay, I just couldn't upload. And so I was a little bit late over the weekend trying to get the videos posted. Eventually, everything switched back and it's working much better now. But those kinds of things can happen. And then for a while, I could upload the videos to YouTube, but I could not to Rumble. So that's why I post in two places. I use them as backup sources for each other, just in case something like this happens. So anyway, looking at the market, we had a slight update. It just ticked slightly positive for the S&P going into the close. It was pretty much negative before that, but we're still seeing this weakness developing. Now, we do have some positive seasonality for this whole week. However, when we look at our charts, we're not seeing a lot of conviction, especially in Tuesday's session, and we're seeing further weakness starting to develop with the S&P. Now, we could get that back. A good solid update could switch everything back over and have it look more positive, but we're just not seeing that yet. We can't hope for that. We can just see what we're seeing right now and then try to evaluate where we're at. Before I get started, in less than a week, I will be launching the program that I have. And I have another slide that goes more in depth about what I actually offer. And I'm going to be putting that in all the different videos. Some of you who've seen this and watched the videos on a regular basis, you're probably getting tired of this. But this is what I found to be kind of one of the best ways just to make it known to people that I do more than just the daily and weekly videos, a lot more. And some folks may really want to take advantage of that. So on Monday, June 3rd, I will be locking down the daily videos. Now, if you're a member, you'll still have access. Or eventually what will happen, probably not in the month of June, but possibly into July, because I'm thinking of keeping the membership part open for the month of June, just to give people a chance to look things over. And there's a lot of bugs that have to be worked out, and there's going to be clunky things. So into June, and then so possibly into July, then it'll be $19 a month if you still want to have early access and you don't want to be part of the membership program. The weekly videos are still going to be made available when I'm able to post those. And as I said over the weekend, I think I was 24 hours late with the daily video and about 18 hours late with the weekly video. Eventually, I was able to catch up, but I was running behind the whole weekend. So I'm really glad we had the extra day. If you want to talk to me about this, you can send me an email. You can leave a comment. If you want to have a back and forth and keep it more private, here is an email address where you can contact me. So let's go back and talk about what happened, and then we'll go through some charts. We did have a higher open. The futures were positive. We didn't see any geopolitical thing happen over the weekend, at least as it applied to the stock market, which is good. It's nice to get through a 3-day weekend. I mean, every weekend has its crazy things, but nothing that really rattled the markets all that much. The futures ended up drifting more positive as we were getting closer to the open in Tuesday's session. So we had that higher open. We got almost up to R1. We didn't quite get there at 53.18, but that, again, this is part of the weakness that I'm talking about. We set the high right at the open, and then we spend the rest of the day either going down or never getting back to that high. And that's not the sign of a really solid market, at least for right now. But that can change. Just something we want to watch for right now. Prices then declined down to the unchanged level. Very common. We filled the gap. Then the market has to decide, is it going to go up from here? Is it going to continue to fall? We chopped above and below the unchanged level, so there was a lot of indecisiveness before we eventually declined and went negative. We fell down below the daily pivot at 52.98. That's kind of the line in the sand right now, is that 5,300 level. And the daily pivot was really close to that. We fell down to S1 and actually dropped below it just a little bit before rebounding back above the daily pivot and unchanged level to close barely positive. We were up 0.02%, virtually an unchanged day. We're still below average with volume, and we have been now pretty much since the last Fed meeting. We're looking positive in the short, intermediate, long term, but there's weakness coming in, and some of our more primary indicators and even a lot of our secondary indicators are starting to show some weakness that we need to respect and be aware of. And later on in this week, it's going to be more about inflation and interest rates. I mean, it's about that every day, but we're going to get the GDP second estimate, and that has an inflation component. And then we're going to get the core PCE on Friday. That's the other big inflation report that we do get. So that's probably going to be market moving. And earnings are slowing down, but they're still coming out for the most part. And then all the different geopolitical things. Some comments. It was a mixed day. It really lacked a lot of conviction, but by the time we closed, the NASDAQ set another new all-time high. On a short-term basis, our list is pretty short right now. The stochastics, because we have 3 different charts on one, so it takes longer for that to not be extreme. And then our slope oscillator, it's right on top of its moving average, starting to turn down a little bit, but it's still giving us an extreme positive reading. We still have the TTM squeeze, which is also showing weakness, but still extreme, the Sean trend meter, and then our 10-day moving average study of the S&P 500, highs minus the lows. Notice one of these. The 150 simple moving average is now dropped off this list. We're no longer extreme. We're still extreme with the 200 period simple moving average. Haven't really changed the scenario now. The Fed's keeping rates higher for longer because inflation hasn't come down the way they had hoped. And now if you saw the weekly video, that's where I go through what is the market anticipating as far as rate cuts. And it's not real decisive, but it's about 50-50 that they're looking at September for possibly being a rate cut. Now, if things change, that may get bumped out even further. And this whole idea that the Fed has been decreasing quantitative tapering, that's kind of worn off, at least to this point. That brought us up out of the lows that we set in April and into May. And it was serving as a real catalyst for things to look better. But that's kind of being left in the rearview mirror now, as that pretty much has been discounted into the market. The dollar was down and interest rates were up. So the declining dollar could have helped things, but with the dollar being up, with interest rates being up, that put pressure on stocks. We closed at 4.54% with the 10-year yield, where after Friday we had been at 4.46%. We're still inverted with the yield curves. We didn't change as far as sentiment. We had been at 53. We're still at 53, and that is neutral. We're positive with our trend. The green line is on top, but the ADX is weakening. It's still dropping below its moving average. However, it's still above 20. So we still see this as a trending environment. And with the slight update, our bias is positive, and I'm still keeping our momentum at mixed to positive. There's just not a lot of conviction right now, but that can change. We did get the FHFA Housing Price Index. It was up 0.1%. Last time it was up 1.2%. The S&P Case-Shiller Home Price Index, 7.4%, more than the 7% they thought was going to come out, and up slightly from the 7.3% that we saw last time. Consumer confidence actually came in stronger than expected at 102. They expected 96. Last time it was at 97.5. So here's some charts. Here's the FHFA Housing Price Index, and we're just kind of going up here. Now, if you're trying to sell a house, you like this, but if you're trying to buy a house, it might be pricing you out of the market. So at some point, according to this, we might want to see things come down a little bit to make housing a little bit more affordable. And then you couple that with rising interest rates when people get a mortgage, and that can put some pressure on the economy. And then here's the month-over-month reading, where it was up, but really dropped off from the reading that we saw the previous month. Here's the Case-Shiller Home Price Index, also going up from the reading from what we saw last time. Consumer confidence, and we break this down in 3 different ways. The blue line is where we're at right now. That's the total reading, just a little bit over 100. When we look at the purple line, that's how people are feeling right now. It ticked up a little bit, and folks are a little bit more optimistic. When we saw the consumer sentiment reading that came out on Friday, all three are kind of jumbled together. There's a little bit of a spread here. So folks are a little more positive looking out. They're a little more negative, excuse me, with how they're feeling now, but they're a little more negative with the yellow line when looking out into the future. Some Isabel Net blog charts, and some of this kind of makes sense. This just kind of backs that up. The longer your holding period, the more likely you are to see gains. So yeah, that's why a lot of folks are longer term investors. That's why they do dollar cost averaging. It takes a lot of work to focus more on the short and intermediate term. You can see really good returns, and that's what my program teaches, but it has to become a bigger part of people's lives. And a lot of people either don't want that or are not able to do that. So they choose to go more of the long path. And it just says, if you've got another 30 years ahead of you, you will eventually see gains. Doesn't mean you won't go through any rough times, but over the long haul, the stock market pretty much has always gone up. And in the very long term, even though we have some really intense times of downward movement, so just we'll expect that to continue over the longer term. And margin debt, when we're going up, this is borrowing money to buy stocks. And when we're going down, folks tend to use less margin because they have to pay that money back. If you buy a stock at 20 and half of that money is yours and half of that money is from your broker, and it goes down to 10, well, it's not like you're on a deal with your broker. You still have to pay the full amount back that you borrowed. It's not like, okay, we went into this partnership here and you get your half and I get mine. No, the full loan is due, and that can really compound the losses when you're wrong. Well, when we're going up, people are willing to take more risk here. And this is just showing the year over change that folks are using more margin than they were in the past. And then wealth inequality, which has always been around here. There's a very famous person that said, the poor will always be among you. So this really shouldn't be a surprise, but I know that this is a talking point for some folks because some people want everybody to be equal, even though that's never actually happened throughout the course of history. And then looking at tech versus commodities. Now, this is a little bit strange. And I have a chart right after this that makes this strange. They're showing that we're topping out. We topped out in March of 2000. That was the high during the .com boom. And they're suggesting that we're close to that here with commodities. And then we fell back. And this is a ratio between the NASDAQ 100 and commodities. All right. So I may have misspoke there for a second. So yeah, you could look at this chart and go, maybe there's a little bit of a problem here. So I tried to recreate this chart, and this is what I came up with. Here's the top. It's a ratio between the NASDAQ 100 and the CRB index. I even tried a couple of ETFs. I tried using different charts. I couldn't even replicate anything close to what we're seeing here. So we have to be a little careful with these charts. Here was the top in 2000. Here was the top back in 2020, late 2020. And here's where we're at right now. And I'm seeing very different results with this than what we just saw in that previous chart. So, because I thought this might be something useful that we can look at. And so I recreated this, and I'm like, no, I'm not seeing anything close to that. All right, and then we're looking on a world basis. We're looking 12 months out into the future and then 24 months, so 1 to 2 years out on a world valuation basis. And when we look out 12 months, we're looking at a PE ratio looking forward of 17.8. Looking forward for the next 2 years, we're looking at 15.9. So yeah, we're under that 20 level with the PE ratio. So this is justifying stocks on a global basis still could have more room to go up as long as earnings forecasts anyway continue to improve. And then this is something that we look at over the weekend. This is money going into high yield bond or funds into different ETFs, and these are junk bonds. And we keep a close eye on this. When people they're worried that interest rates are low and they want to get a good yield, they're willing to take on more risk to get into riskier bonds. And that's what high yield bonds do. We also call them junk bonds. We had been seeing money coming out because the market was like, okay, they're going to start cutting rates. Maybe we've topped out with interest rates for right now, so we're going to start pulling money out here. Now money is starting to go back in as things are not as certain as they were just in the recent past. Couple of charts here. I forget who posted this, but this just shows the Magnificent Seven. Let's see, 2, 4, 6. Yeah, Magnificent Seven. And just what a major impact that NVIDIA has on things, and just how much of a drag Tesla is on. The green line here is NVIDIA at the top. My God, it's up 115% for the year. And that's before Tuesday. It was up even more in Tuesday's session. And then we have Meta, which has been doing quite well, and then Google, and let's see, what's the gray one? Is that Amazon? These colors are kind of hard to tell. And then kind of brownie here, Microsoft, and then light gray, Apple. It's Apple that's been kind of dragging things down. It's down on the year, not much, 1.5%, but it's Tesla. It's down over 31% in 2024. Oh, this was bar chart that put this out. And that's what's been dragging down some of the indexes. And it's really been dragging down the discretionary sector, which is a sector we want to see doing better if we're going to be more positive on the outlook for the market. Then, because of the passing of Bill Walton over the weekend, if you're a basketball fan, I remember watching him back in the early 70s under John Wooden. This was before they could dunk the ball in college and they didn't have a three-point line yet. But he says, when everybody thinks alike, nobody thinks. And this is the one of the foundations of my program. I try to teach critical thinking. I'm not telling people what to do. I'm trying to give you enough information and enough tools so that you can develop a skill to reach your own decisions, because that's ultimately what successful people in the market have to do. You have to think for yourself. And it's developed into this, tell me what to do. You have an insight that I don't have. You have inside knowledge that I don't have. People think that's the case, and it's really not. It takes you longer to think for yourself, and a lot of people just don't want to take the time to do that. But that doesn't just apply to the stock market. It's a lot of other things: business, relationships, music, even sports. You got to do things. You a renegade, that's what made the Beatles so popular. They were rebellious and they broke all the rules, and we still compare every other music group to them even to this day. All right, then another thing, and I've said this before, and this is a quote from John Maynard Keynes, and you can have whatever opinion you have of him. This is pretty much, he was a big influence at the Treaty of Versailles, which ended World War I. And this is pretty much the economic philosophy that, especially in the US and to a degree in Europe, is implemented. And again, you can agree or disagree with that. And that's not the point of this slide. But he did make a very important quote that people use. And sometimes we have to remind ourselves that markets can remain irrational longer than you can remain solvent. And now he's attributed to that. I don't know if he really said it, but I saw this and figured, okay, you might want to see this one too. Because there are times when the market shouldn't go up anymore, and then it does. Or the markets can't go down anymore, and then it does. Because we're trying to apply our human logic to a whole nother beast that has its own logic, and we can't put the stock market in a box. We try to. That's why I look at so many different things. That's why my videos are longer, because we're trying to take as much as we can. And if you just base it on a few little indicators, I know analysis paralysis and all that stuff, but if you just base it on that, you're not really giving yourself much of an edge at that point, because the market can be crazy. It can defy logic at times. All right, and then here's Tom McClellan. He's going back to the beginning of the year, showing just what of an impact NVIDIA is having right now. And this is just the change for the NASDAQ 100, the S&P 500, the New York Stock Exchange, small caps, and the industrials. And it says those indexes which have NVIDIA in it, which includes the NASDAQ and NASDAQ 100 and the S&P, those are the ones that are doing better. The ones that don't, the NYSE, the small caps, and the Dow, they're negative over this last period of time. And then to show this again, this is also in ETFs. Well, if you're in the QQQ, this is where the strength is coming from. It's also in the SPY, which is doing better. But then you have the equal weight S&P and the equal weight QQQs. They're actually down when you treat all the stocks the same. Not necessarily a surprise, but this chart just kind of backs up that whole idea. Here's our intraday chart where we did have a higher move, at least at the open, but this was the high. We just set the high right at the open, came down. We danced along the unchanged level. We were kind of drifting a little bit higher. Then we broke lower, fell below the daily pivot, came down a little bit below S1, and then saw a bounce here. We're having a really hard time. And it was literally the last few seconds that the market was open that we actually ended up going positive. So it could have very easily turned into a negative day, but it still goes in the books as a positive day. Here's the intraday chart. The only encouraging thing that I take away from this is what was happening while the U.S. market was closed, and we didn't see a real gyration of the futures during that time. And with a holiday weekend, that's encouraging. We're still looking okay here. The blue line is above the red line. Growth is outperforming value, and it was up, where on an intraday basis, value ended up being down. We're looking better here with our growth to value ratio for the S&P. So this is internally showing that we're hanging in there for the time being. So when we look at our end of day charts, we were up with growth where value was down. We were down more with the mid caps, but down less with the small caps when we look at growth. And so here's our small cap growth to value ratio, ticked down a little bit here, not really showing any strength. Mid cap ticked down a little bit. Again, kind of maybe a basing pattern here, but not really going up the way we would like. But we are seeing a little bit of an improvement here with S&P growth to value. That has been coming out, but we really haven't broken out, at least yet. This is looking a little better. These two ETFs that we look at, where we're coming even more up out of the upside of the rainbow here. So this is more positive, but well, I guess we did see a little bit of a bounce here with discretionary to staples. I'm so used to saying, but discretionary fell behind. It actually, and it wasn't so much that discretionary was up, it's that staples were down in this whole ratio. Large cap growth still doing pretty good, hanging in there for the time being at recent all-time highs. The Wilshire also coming off of recent all-time highs, and this looks across the market. Here's our trend where we're dropping below the moving average and the ADX is declining, although we're still above 20. So that's a trending environment. We're also seeing the green line coming down right now. So that's not giving us an awful lot of confidence as we look at the bars here, and have pretty much been chopping sideways recently. Here's the short-term look, also dropping below the moving average, and the green line is declining. We continue to be dropping off with volume. And here's our weekly chart looking at 84.87. When we look at this composite of different sentiment gauges taken together, this is suggesting that we're extreme positive, where on the chart that we look at from CNN Money, we're neutral. We're pretty much right in the middle. And then we do get the insider transactions ratio. This is legal insider transactions. We are seeing it ticking up just a little bit. So then we look at the ETF, where it's just about at its 50-day moving average. The Ulster Index, pretty much flat after it did spike up a little bit last week. Don't have the latest reading from Investors Intelligence. That'll come out, I'm not sure, with the holiday shortened week. And we did go up with the VIX, both with the line chart and the bar chart. We've been getting just super, super low readings here, but it did pick up in Tuesday's session. We're seeing a little bit of a tick up here with the volatility of the VIX. We're kind of underneath the moving averages currently. We're starting to turn back up ever so slightly with the momentum of the VIX. It had been going down. Now it possibly could be getting ready to go back up. And we're watching this. The skew index is still up in this red area. Once we finally top out and start to come down, that's when the market thinks some kind of a big move will happen. As I always say, we can make a case for either side, up, down, or continuing what it was already doing. So we have to use other charts to reach a better conclusion. The equity put call ratio did decline on the daily chart here, probably because some hedging was coming off after the weekend. but we're still going up with our 5-period chart, and that tends to be negative for the market. And we're not really showing a real pickup in volatility here. When we look at the volatility risk premium, we're still just at the lower end of this band. We ticked up with this fear gauge. We also declined just a little bit with this other fear gauge as well. This is a newer chart. Over the weekend, I was going, hey, why don't we have a chart of high beta stocks? That's what people like to get into when the market's really going up, because they outperform the market, versus low beta stocks, which tend to be more defensive. And after creating this chart, I'm like, well, this doesn't really tell us anything right now. When we were really coming down in 2022, notice how this was declining. We finally hit a bottom and then started to come up in 2023, even though we were making a series of higher lows here with this ratio. In 2024, just blah, 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 doing a lot of bumper cars right in here, but this could be a helpful chart to look at. Seeing a little bit of a disappointment here. We declined with the advanced decline line based on price. Even though we closed up with the S&P, we were flat to slightly declining based on volume. We are seeing a bit of an expansion of new lows and a contraction of new highs. So now the 5-period and the 10-period are declining. We dropped below zero again with the advanced decline ratio. That's the blue line. That's a shorter term one, where the red one is still above zero. But accumulation distribution is still looking okay. We're above the moving average. We went up, and that's looking better. But we're kind of flat now with the moving average declining when we look at the Chaikin money flow. Not seeing much of a change here with the Chaikin oscillator, but it's still above zero, so that's positive. And not really seeing a big change in our cumulative advanced decline line, and not really much of a change in the NYSE advanced decline line. This other advanced decline line, not really changing. And not seeing, this is just showing a real lack of conviction right now. When we look at the common stock, not seeing much of a change here with the S&P study based on price and volume that we follow. And we're hanging in there for right now with our advanced decline line studies, but we are rolling over with the NYSE common stock, the S&P mid caps and small caps. But if we can stay above these moving averages, that would still maintain more of a positive stance. Here's our chart, and nothing really happening. We're just chopping sideways right now, and volume continues to drop below average. Here's our short-term stochastics chart, just barely on the brink of being extreme in the short term, coming down and no longer extreme in the intermediate term, rolling over but still extreme positive in the long term. Here's our 20-period double and triple moving average study. We're dropping below both of the lines now. It's going to be a lot more positive if we can get above both of these lines. We did decline with the 20, 50, and 200 moving average study. So that's showing a little bit of weakness there. We're still positive, but we decline with the force index. Want to keep an eye on the regular 20-period moving averages to see if they end up providing support if there is more weakness. We're not extreme right now with the standard deviations chart. We're into the +2 channel. The balance of power is declining, but it's still positive. The go, no go is switching a little more negative with the lighter shade of blue bars. And we're just chopping sideways, but we're still fairly close to this highest high value, and we're above the midpoint. The TTM squeeze is still extreme, but it has been declining and turned to the darker shade of blue. This is encouraging, though. The double and triple exponential moving average study based on 50 periods, we have not broken below the support yet. So that is holding, at least for right now. And that's more intermediate term. We do want to watch our regular 50-period moving averages if we see more weakness and then end up breaking through the 20s. The ease of movement is declining, but still above zero. The Erin came down just a little bit, but is still positive. This is one of the more blatant warning signs that I'm seeing. The McClellan oscillator, we're below zero, so that's negative, and we declined in Tuesday's session. So that's turning our summation index, both based on price and volume, down. And both of these together I consider to be primary indicators. And this is secondary because it measures the broad market, but we're also looking more negative with the NYSE McClellan oscillator. So we're declining with the summation index based on price and volume. This is also a primary indicator and is negative and has been negative. The Swenlin trading oscillator based on price and volume are below zero and declining. And we're rolling over a little bit here, but still looking okay when we look at the PMO. However, based on price, we're crossing below the moving average. We're just barely crossing below the moving average based on volume. The studies inside of the S&P, looking at the PMOs, we're declining with the rising PMOs, we're declining with the buy signals, and now we're starting to turn back down with the PMOs above zero. This is the weakness that's developing that I'm talking about. Not just this chart, but other charts as well, kind of coming together. We're still neutral with the Elder's Impulse system for the S&P. We're still negative with the parabolic SAR. Over the weekend, the weekly chart is still positive, but with these dots on top, this is also a primary indicator and a concern. The slope is dropping down just a little bit below its moving average, but still giving us an extreme positive reading. The MACD is rolling over, but still positive. So we're looking more weak with the slope oscillator, rolling over, but not at the moving average with the TSI. Those are our two short-term oscillators. Rolling over with our intermediate-term oscillators, but have not crossed the moving average, showing a little bit of weakness, but still going up with our longer-term oscillators, the TRIX and KST. Here's the moving average tree, still above all these lines. So that is holding up. Bullish percent index did decline. It would be nice if this was actually going up. It's going to turn negative if we drop below 50, but if we could turn back up, that would be more positive. We're also declining with the NYSE bullish percent index, but still above 50. We're declining with the NASDAQ 100 bullish percent index. We have the NASDAQ 100 hitting all-time highs, and this is going down. That's more of the weakness that I'm talking about. Now, it's still positive since it's above 50, but the fact that it's declining is a concern. The money flow is declining, but still above 50. The ultimate oscillator actually bounced up off of 50, so that's more positive. The vortex, the green line, is continuing to decline, even though it's on top. The RSI, they're holding up for right now with the RSI 14 and the RSI 9 on balance volume because we had an update. See, and I like to explain this every once in a while. One of the first technical analysis indicators was on balance volume. It was developed in the 60s by Joseph Granville, where I used to watch interviews with him and they had to tell him, could you not be so close to the camera? Your nose is hitting the lens. I mean, he was one of those in-your-face kind of people. But really, what he would do is if we had an update, all the volume was positive. If we had a down date, all the volume was negative. And I don't like that. And for a long time, I didn't use on balance volume, but so many of the indicators like Carl Swenlin, the PMO, and indicators like that, they're developed around on balance volume. So I want to keep an eye on that. So since we had an up day, that means all the volume counted for positive and we're above the moving average. The stocks above their 20-period moving averages that are in the S&P, that's declining. And here's our study. After getting extreme positive, showing a good up thrust here, we're falling back. But this has happened before we see some kind of a recovery from here. So this isn't necessarily showing impending doom, but for right now, we have to treat it for what it's telling us, and that's showing weakness. We're also declining below 50 with the 50-period moving average study. We're declining but above 50 with the 100, also declining and well above 50 with the 200. Copy curve is now crossed over negative. It's below its moving average. The Sean trend meter is still up into this second area being extreme positive. We're losing the Pring bottom fisher signal. That was generated right near the end of April and ended up being a pretty good signal here. Didn't hit the, because we had a bit of a false start with this upward move, but this hit it pretty well. But now this signal is going away. And it's not necessarily negative that we lose this signal. This is supposed to generate buy signals where the sells, there are really no sell signals, at least the way I use this chart. Then our different charts, the Hike and Ashy, we are chopping sideways here based on this trending method. We're positive but pointing down with the Kagi chart. We're still looking okay with the Renko chart, and we're positive with the 3-line break. So a bit of a mixed picture there. We dropped below this red line with the 150. We are declining, but still above the red line with the 200-period moving average study. And we're coming up close to what potentially could be the end of the 50-day cycle. I use my software and it picks out a date, and then I go back and I look at this again, and then the date changes. But just know that we're kind of getting close to the end of this cycle. Not something that we use to make a decision, but other times it's been a little bit helpful. We did get a Hindenburg Omen initial signal after Friday. We're waiting now for a confirmation. We need to see another spike within the next 20 trading days. So kind of near the end of June. Between now and then, it has to happen. When we do see a confirmation, you can see other times when this was kind of a big deal. But we also had a spike in February that was not confirmed, and it led to nothing, and the market went up. So we'll just be watching this one. We are positive still with the Keller market model across all time frames and different indexes. And we're negative with the mid caps in the short term, where all the other indexes are positive. And believe it or not, they went back, because I was saying, positive in the short, intermediate term, mixed in the long term. Well, they went back and said, oh, gee whiz, we should turn this to positive now too. All right, or was it the bottom one? I don't know, but now we're positive across the board with the decision point scorecard. We saw an awful lot of red. NASDAQ did set a new all-time high right at the open, and then we just were kind of fighting defensively ever since then, going into the close. And we did have energy and tech were up with communication. Tech and communication, these are the areas we want to see be stronger. Staples were weak, and discretionary was down, but not as much. Utilities were also down, but not very much, and virtually unchanged. So just not a really positive day overall. This is something that I was pointing out over the weekend, where we've set recent all-time highs with the Dow. We've also set a new all-time high with the NASDAQ and NASDAQ 100. But when you break this idea behind a new way of looking at Dow theory, and you use the equal weight for the S&P, we have not hit an all-time high, and now we're declining. That would be a negative divergence when we compare it to the S&P weighted index. We also have not hit an all-time high with the QQQ equal weight as well. So this is a negative divergence, suggesting that it's the bigger stocks that are really helping things. And equal weight is starting to really turn down when compared to the S&P. And we're seeing this as well. When this ratio is going up, that means the big stocks are outperforming. The Dow's kind of messing with its 50-day moving average after setting an all-time high. It's not doing all that well and was down in Tuesday's session. We're still negative with the Elder's Impulse system for the diamonds, setting a new all-time high, but coming right up to this pivot point for the NASDAQ. This could produce some overhead resistance. Also, a little bit underneath the overhead resistance with this pivot point, but still getting kind of close to that. The Qs still remain neutral with the Elder's Impulse system. The momentum is still positive for the NASDAQ 100, and we're above all these moving averages, so we're looking good with the QQQs. Small caps, of course, they came to the high end of this range, and now they've been going back down and dealing with their 50-day moving average. The small caps still remain negative with the Elder's Impulse system. We look at the Russell 2000 small caps. We're right on 50 with the RSI, still above the 50-period moving average here in a longer-term uptrend. We're starting to see more weakness as far as the shorter-term momentum. The mid caps also dealing with their 50-day moving average. Now, if you remember back into April when we were going down and we found some support, it was the mid caps that really gave us some support, and then we bounced up out of that. Can we bounce off of this 50-day moving average with the mid caps? I know it's like, what, NVIDIA, large caps, they're the ones that really control everything. Well, there's times when the mid caps actually take a bit of a leadership role. And for a lot of 2024, especially since the end of January, this has been one of the stronger indexes. It's not now, but if we can find some support in here and then bounce up, that would be more positive for the market. However, we're still negative with the Elder's Impulse system for the mid caps. Apple was virtually unchanged and in a downtrend, but above both of these lines here. The longer it can stay, the more chance we have of actually switching back to a golden cross uptrend. Tesla was down and is still dealing with its 50-day moving average. NVIDIA is going to the moon and beyond. So, and that's really the buzzword that everybody's talking about. Microsoft was up barely, but still looking pretty good. Meta was up and still underneath its 50-day moving average. Amazon was up and still also coming back up to its 50-day moving average. Google was up and still looking fairly solid, but not setting an all-time high. Netflix is looking good too. Not back to the all-time high here, but breaking out above its 50-day moving average. The FANG index setting a new all-time high. Financial sector, it was down, actually dropping a little bit below its 50-day moving average. This is encouraging, though. The staples to tech ratio is declining again, and we want to see that continue to decline to show that tech is outperforming staples. Staples are defensive, tech is growth. And the dollar ended up actually being up a little bit on Tuesday. Actually, I think it was down, but it's showing it up here. And then looking internationally, we're starting to see the shorter term relationship fall off just a little bit, where the longer term relationship is still pretty strong between the S&P and then the rest of the world. The staples sector, it was down, but still in a longer term uptrend. We're going to be watching to see if it comes down to its 50-day moving average. Utilities saw a little bit more profit taking, but still, after just going parabolic here, have dropped back lately. Healthcare, we're keeping an eye on that. This is another defensive area and was also weak and dropped under its 50-day moving average. Energy has been underneath its 50-day moving average, but still in a longer-term uptrend. Now, energy can either be defensive and other times it's offensive. So I'm seeing it more as a defensive area right now due to geopolitical events. The total U.S. stock ETF, we weren't up. We were down barely, but we're just coming off of recent all-time highs. We were up with the 10-year yield. Apparently, the auction that they had on Tuesday was not met very well, and that pressured interest rates to go up. And so that pressured prices for bonds to go down. When we look at the ratio between bonds and stocks, this is continuing to decline, and that's what we want to see to stay more positive. We're still going up when we look at the tech sector compared to 3 to 7 year bonds. That's going up, and that's positive. The Q is also going up when compared to bonds. That's positive. We're still going up with our ratio here to suggest the market thinks we're going to enter into a soft landing. We look at the broad market compared to the shorter term bonds, still going up outside of the rainbow. We do another broad market measure and look at further out bonds also continuing to go up. So this is positive. And then we look at the Eurozone, comparing it to American bonds. This is also continuing to go up. And we're seeing some improvement with accused S&P. That's encouraging. But we're not seeing much of an improvement with discretionary S&P. That's discouraging. But we're going up and showing some improvement when we compare large cap growth to large cap value. So we're going up with the large caps, coming up slightly above the moving average with the mid caps and the small caps. We want to see more follow through here. We're still extreme positive, and that's suggesting good momentum with the 10-day average of the S&P 500 highs minus the lows. This is negative. We dropped below zero with the advanced decline ratio. We're still above zero based on volume. And the S&P to utilities ratio ticked up, but we want to see this keep going up and not going down with any real conviction like it has been doing. Also, we want to see this ratio continue to decline. That would be more positive for the S&P. So what's our outlook? We're still positive with our technicals, but this weakness just continues to develop. But we do have positive seasonality in the background. We're going to get the FHFA Housing Price Index, and we just got this, and I forgot to change this. So we will go to the next slide, where we're going to get the MBNA Mortgage Applications Index in Wednesday's session. The second GDP is going to come out on Thursday, and then the core PCE that's the biggie that's going to come on Friday. And let's see, yeah, showing those same things here with this particular calendar. We're neutral to positive with the Dow, where we're positive with the S&P and NASDAQ when we just look at May 29th. And we do have some positive seasonality, not only for Wednesday's session, but the green dash line is going up into the end of May. So we have that working for us. Wednesday is one of the more negative days of the week. In fact, it's the most negative day of the week based on what happened in 2023. Here's where we're seeing a potential positive seasonal bias here going forward from the end of May and then into June. We also see positive seasonality according to Carson going into the end of May. May tends to be up, but we don't know if we're going to be up 5% in May. They came out with this chart with still a week to go. So this is like, okay, we'll have to see how that works out. And we want to start looking at June. This is the daily chart from Stock Traders Almanac. Nothing's marked on here because we haven't started it yet, where we often see some positive seasonality going into the early part of June, then some weakness, and then sideways where we might see a little bit of weakness going into the latter part of June before we see more positive seasonality into the end of June. Here is June during election years going back to 1950, a pretty good track record, up 15 out of 18 times, down 3 out of 18 times with a return of 1.3%. And then Tom Bowley still has us in this more positive time going into the end of May. So the warning signs, we're still just keeping in the background that the S&P did make an all-time high while staples and utilities were strong. And this can be a warning sign that we're keeping an eye on. We're also watching especially healthcare and then energy just to see how it behaves. Growth to value and discretionary to staples, they're improving, but they're not really showing any true leadership at this point. We had a pretty good day on Tuesday. We want to see if we can get more follow through with that. The STO, the Swenlin trading oscillator, is negative. The parabolic SAR is negative. The slope oscillator has dropped below its moving average. The Copic curve is now crossed negative. And the equity put call ratio, the 5-day chart, is going up, and our summation indexes are declining. The positive signs are oscillators, except for the slope oscillator and with the S&P and NYSE McClellan oscillators, they're still positive for the most part. We're still looking okay with the bullish percent index for the S&P, the ultimate oscillator, the Chaikin money flow, Chaikin oscillator, money flow, vortex, and the momentum for the NASDAQ 100 and bullish percent index are looking okay. And then the financial sector. So our conclusion, we're still positive, but weakness continues to develop, but we have positive seasonality. And that's what I concluded for the short term, even to a degree in the intermediate term, not so much the seasonality, because we have to have it work in the short term before it can even really impact the intermediate term. We're still positive in the long term, even though we're dropping down a little bit from that 150 moving average. Thank you. I really hope you found this helpful. I hope you have a very, very good day, and I will talk to you in the next video.